starting to ask very cogent questions about this. But let's step away from the stock market for just a minute, and let's just say, if I was to come to you, Mike, if I was to say, look, I've got two choices of some investments. I've been looking at some investments, Mike, and I trust you, and I value your opinion. One of them has a limited profit potential. I mean, once it's done, it's done. Okay?
Okay.
But I also have a risk. In fact, my risk is, well, I could lose everything. On the other hand, I've got this other investment that I'm looking at that there's no telling how high it could go, but the really good part about it is that I'm able to keep my risk down into single digits. Just in case I'm wrong, out of $100 that I invest, I'm going to have $95 back. But it's really unlimited how high it could go. Which of these two do you think would be a smarter play for me?
Well, I would suggest that you go with method number 2. You want to see something that has the potential for a high gain, potentially high gain, but if you're wrong, well, you're not going to risk too much of what you already invested.
That's right. Now, what I've just done is I've just described two different hedges on a long stock position. If you own long stock and you want to hedge it with a covered call trade, Mike, you're going to take in a little bit of income.
Sure.
But you're also going to cap your upside.
Mm-hmm.
On the other hand, shorting a call is a near-term bearish play, right?
That's right. Yeah, we're going to expect that the stock stays around the same price or doesn't rocket above the strike price of the call that we sold.
Right. On the other hand, if we buy a put, is that also a bearish play?
By itself, absolutely. If I just buy a put, I'm expecting the stock to drop in price. I'm speculating in a directional movement to get a leveraged increase on my option.
Yeah. You know what? If a lot of folks, if they think that a stock is going to go down, they just totally load up on puts. And if they're right, that's going to make for an outsized return.
Mm-hmm.
Okay. But on the other hand, if they're wrong, it's that leverage is going to be used against them, and that's not the way to go. At least I don't think so. The way that option contracts were designed and what they're designed for is to be a hedge, okay, just in case we're wrong. Okay, so this represents the hedge here, Mike. We've got our stock ownership, but we've also got, just in case we're wrong, we've got a floor to what our losses could be.
Mm-hmm.
Okay? Now, Mike, the reason that I believe that so many people, even though they're maybe aware of these strategies, I think the reason that so many really smart people get into selling covered calls is that the idea of taking income from a stock that you already own is really attractive. Now, a little bit later in this presentation, I'm going to show how one of my pupils here recently was able to bulletproof a stock, but also take income and also have his upside unlimited.
Mm-hmm.
Does that sound pretty attractive to you?
Absolutely, yeah. I mean, I have a place right now where I've got, what do I have? I have 3 positions like that right now. Well, two positions like that right now.
You got 2 bulletproof positions and one that's pretty darn near?
Yeah, but it is capped. That silver wheaton position we discussed on Saturday and I showed again on Tuesday, it is essentially bulletproof, but I do have a capped gain because I used income method number 1.
Right. Is that a near-term call? Is it going to expire?
In August. I'm hoping it's going to expire. It's a 21 call, and it's for August, and I think silver wheaton right now is around $19. So I'm looking for that to expire worthless, and then the position will be bulletproof, and I can continue to move forward.
Yay! We love when we're bulletproof and we don't have a cap on our upside.
Mm-hmm.
Well, anyway, Mike, the idea of buying insurance for your stock is not as attractive. In fact, the biggest objection that I hear from everyone is, well, geez, you limit how much you can make. You know,
yeah.
You cut into your profits. And that's not really so. In fact, honestly, Mike, I've seen folks be able to completely pay for their put options by using income methods. I've done that as well.
Mm-hmm.
And I've actually even had some cases, where my stock goes up, say 8, 9%, but my position goes up 12.9%.
Mm-hmm.
Okay, and it's because of the income methods, and it's done within the context of still having insurance. Okay, so I'm going to say that buying insurance, it may not seem sexy, okay, but you know what? It's absolutely vital to learn to keep a cap on your losses, but not a cap on your upside. Okay?
Right.
Now we're going to do a comparison here, Mike, in this very presentation, okay, about December of last year, or November of last year. We had a lady come in that said, well, I recently did pretty well with a covered call trade with C-Trip. Can you tell me if your system would have worked better?
Mm-hmm.
And I said, well, let's take a look at it. Give me your numbers, okay? So here's what she did. She picked up C-Trip, okay, when it was trading at 57.88. Now, Mike, she didn't buy it at 57.88. She did a covered write, which means essentially that she did a covered call at the same moment that she bought the stock, okay? So she sold the November $60 call options for $2.30, and C-Trip at that time was trading at 57.88. So her total cost basis here is 55.58, right?
Mm-hmm. Yes.
Okay. Now, if that stock goes down, how protected is she?
Well, she's really just protected the $2.30, isn't she, Kurt?
Yeah, the $2.30 is the extent of her hedge. If that stock goes down to $40, she loses $15.58, right?
That's right.
And that may sound ridiculous. You might be saying, well, Kurt, it's not going to go down by $15. Well, I beg to differ, because guess what? The stock went up by $15.
Mm-hmm.
She was playing a volatile stock, and if it can go up by 15 in the matter of a few days, can it also go down by 15 in a matter of a few days?
It absolutely could. That's right.
Right. So this really isn't much of a hedge as far as protection is concerned, but let's see how profitable it was, okay? She did do pretty well. With a buy price of $55.58 and the obligation to sell at 60, because it was the $60 calls, here's what happened. She was called out of her winning stock, okay, and needed to deliver them at $60 a share. Now, the argument is, well, she could have rolled those calls. Well, how are you going to roll the calls when the stock is up above 70? You're going to buy it back for more than you received, right?
Yeah, it's going to be very tough, isn't it, Kurt?
Okay, but long story short, she made a really nice profit. Okay, it's $4.42 per share, and if you divide the $4.42 by the $55.58 that she invested, that is a decent return. Okay, $4.42 per share profit is good. $13.36 profit is good. All right, 7.9% profit in 16 days is good. Okay, and I don't like to give this annualized return example, but a lot of the covered call trading gurus do, so I'll put it up there. I don't like that example. Why? Why is that why don't I think that's very honest, Mike?
Well, it's making a very large assumption. I mean, you had success on this trade, great. You made 7.9% in 16 days, but are you going to be able to do that every 16 days? That's a lower probability that that's likely to happen.
Yeah, that's a big assumption. All right. But honestly, that was a good return. But the question was, well, would your married put have done better? Where you're paying for insurance, and rather than shorting a call and taking income, how could you possibly do better if you're paying more money for a long put? And I said, well, okay, let's look at the blueprint, and let's look at the historical data from that date, and let's pick the put option that the blueprint would say we should get into. Okay, so if we're bullish, you do a cover call trade if you're bullish, right, Mike?
Yes, if I'm neutral to bullish, that's a strategy that is applied. Absolutely.
Okay, but if you're bullish on the stock and it costs $57.88, I'm not going to be taking a credit, Mike, by selling a call. I'm going to be paying out $13.70.
Mm-hmm.
Okay, now that doesn't look very attractive. But what I'm doing here, Mike, is I'm doing it according to the blueprint. I'm buying, it's November, I'm buying 6-7 months out and deep in the money. I'm buying these puts according to the dictates of the blueprint. Okay? And what I end up here is a total cost basis of $71.58. Now, is my investment greater?
Yes, we have more outlay into the position. You have more capital into the position.
Okay. Now, another thing that I should mention is instead of a cost basis of $55.58, I've got a cost basis of $71.58. But, Mike, I've got a guaranteed exit. And that guaranteed exit is because of that put option. No matter what happens to C-Trip, if it goes down $15 a share,